Right. Hello, everyone. How's everybody doing? So if you can hear me since the show is live, give me a thumbs up. If you don't have a sound issue or sound quality issue, we got an amazing show today, amazing guests. And today in the office, we have Mr. Brian Present. How are you?
Hey, you're doing well. I'm doing well, thank you. How are you doing today?
I'm doing good. I had a very busy day. Work was extremely busy today. Not done yet. Setting up the interview, back and forth, couple of emails with developers for trading terminal. It was a busy day, but we survived. We definitely survived. Good trading day. I made what, $500 today, which is pretty good. I'm happy, and then I'm gonna take 2 trades live before the market close. I'm gonna do a straddle on PayPal and straddle on Airbnb. Hopefully it will work out. What about you, Brian? How was your day?
My day was okay. I mean, sometimes you just you don't get to follow the the stocks that are the best ones that end up in play, and things were pretty choppy at the open. I mean, I tried an Uber trade. It didn't work out that well. I had to average down to get it to even be almost flat.
Was it a long side or?
Yeah, it was long.
Side?
I played it as a fallen angel. It dropped at the open like I expected, but it lost a VWAP and it continued to drop. I kind of knew it was going to bounce back, so I just hung with it. And then when it looked like it was starting to bottom, and it was just a feel, I just added more. I think it was around 27.30, I think it was.
Yeah.
And then it got back up to, then my average price was 27.70.
Yeah.
And I was able to get out some at 27.90, and then the rest was just I had to stop out again because it dropped back down again. So anyway, that was okay. But then when I was trading with Megan, we kind of caught a bottom there on the Qs.
The
started
Qs?
to bounce.
Yeah, nice.
And then I jumped on with, before I came down here, I jumped on with Thor. Thor was just, I just happened to jump on. He was talking about how he'd just caught the top of SPY.
Yeah.
And it was starting to sell off, and I was looking at it and I thinking, yeah, I'll join Thor. So I joined in.
Oh, so you shorted SPY right around here for this move down? Nice.
Yeah, it had a big drop. And sort of rode that part of the way down. So that kind of made up for the poor opening. But that was just lucky. I just got on with when Thor was just going short there. So thanks to Thor for making my day a little bit better.
There we go. Shout out to Thor. Yeah,
Yeah.
absolutely. So market has been really choppy. I mean, we're going to talk about today what happened last month, because this is the first trading day of August. We're going to recap July. And July, believe it or not, was one of the strongest months we've seen since 2009. So unprecedented. I know we hear this word a lot, unprecedented, but it was an unprecedented month in terms of, a rally that we saw. And if you were short and you didn't have proper risk management, it would have been really tough for you. So I'm short IWM, so it was.
Yeah.
I have proper risk management in place, but it was a pretty rough month looking at my unrealized loss, but it's part of the game. Let's see what happens. IWM is flat right now. Brian, what do you think? What's your recap of last month? Do you think that was kind of a fluke and there's more pain ahead? This is where we need your years of experience. This is where it comes in play.
Yeah, I think this rally has sort of caught a lot of people by surprise.
Yeah.
When you listen to the commentary on some of the the talking heads. People I don't think were you always expect these rallies in the middle of a bear market,
Yeah.
but I think the sort of, if you want to call it the veracity of this, this rally has been a little bit more than what people expected. I mean, you talk to you listen to a lot of people, they still say the bottom's not in yet.
Yeah.
You listen to other people and they say, well, Apple, Amazon told you things are, they're not that bad.
They're not
and I
that
think
bad.
that can probably sort of summarize what what we've seen so far in earnings. It's like, people were expecting it was going to be bad, but it wasn't as bad as people had expected. And then a lot of people, I don't know what, I think Fed Powell kind of, I don't think he intended to, but he kind of said, we're kind of we're at the. It looks like we're at the end of our tightening cycle,
Yeah.
and you know, things might be. We'll see what happens from here. And I don't think he intended to say that. I probably replay later and thought, well, I should.
Yeah.
People didn't really take what I said, the way I wanted them to.
Yeah.
So I think really that lit a fire into the market on Thursday because people thought, well, the tightening's over.
This is it. Yeah.
But yields are back up a little bit today. So, but they're definitely have been rolling over. They're down. As of this morning, they were down like 1 percentage point in 6 weeks.
Which is insane.
Which is insane move.
In the
3.5,
bond market.
just around a 3.5. Middle of June to just around 2.5.
2.7, yeah.
Yeah. Well, it was 2.5 this morning. It's come back up.
Yeah,
today,
exactly. Which is so interesting. So on Trading Terminal, we have it under TNX, so it's kind of showing you where the 10-year is at. And just for comparison, right now, the Fed's fund rate is at 2.5. So right now, at a reverse repo facility, you can get 2.5%, and the 10-year is at 2.7, which kind of shows you how the yield curve has been inverted and has been inverted for a while. But you're absolutely right. It seems like they're at the end of their cycle. Powell was talking about by the end of the year being at 3% or 3.5% maximum. They're already at 2.5%. There's 4 more meetings left. That means that 2 of the meetings they might not do anything or just do it by 25 basis points. So of course, market really liked that. I have some really interesting data that I'm going to show you later in the show. But on a sector performance, as you can see on my screen, the best sector was consumer discretionary. Yeah, absolutely bodied the rest of the S&P 500. After that, technology. Again, these are pretty cyclical. So it tells me, as you said, Brian, that this rally wasn't really driven based on fundamental, but it was mostly rates driven. So because the yields were dropping and it seemed like the Fed is done with their hiking cycle, it was mostly driven by the more cyclical sectors perform better.
Yeah, well,
I don't know. What do you think about this?
Yeah,
assessment?
no, definitely. There was you could, and I watched the various sectors throughout the different weeks. At the end of each week, I do, I'm always reviewing what sectors were good, and it just was flipping back and forth. I mean, one week, consumer discretionaries and technology was strong. The next week it was at the bottom of the list because the market rolled over and all of a sudden risk off was where money was going. So I've never seen sort of markets rotating in and out of these various sectors so much. That's why it makes it hard to swing trade in this type of market. We had a conversation a week or 2 ago with Brian Shanahan saying the same thing. Swing trading is a little bit more difficult in this market. So you just got to pick your spots, and it's still possible, but it's not as easy when the market's not
as easy.
One direction.
And when you talk to rookies, people who don't trade, and they have just the idea of trading, they're like, oh, you just short the market when the market's going down. Well, you get rip your face off rallies that could wipe out your account, even if you're betting on the right trend. Like in this case, like if you thought the market's going down, you would have started shorting beginning of July, you would have been down 20%. We had a massive rally. So it's really not that easy. Risk management is really important. Let's go into the slides. This is again very interesting for me. We had the best month in terms of performance, best 1 month return since the global financial crisis, Brian, on the high yield HYG, so high yield corporate bonds. Yeah. So that kind of shows you that, maybe this is a short squeeze, but the junk bond did very good last month. So again, could be signal that the rate hike is almost over. Yeah.
Because when you see, we're talking about the high yield bonds. The yields are high because investors and traders look at those and say which ones are at the most risk of defaulting.
Yeah, exactly.
And so that's why, the more you're at risk of defaulting, the higher you're going to have to pay for yield. So. So when people are looking at debt quality, the ones and when you're talking about going into recession, or possibly going into a recession, that's, people are looking at companies and they're looking at their bonds and deciding whether, it's more risk, and if it is more risk, then they've got to get better yield.
Better yield, yeah, exactly. Because I think I remember the Coinbase has a 2030 bond that is trading at like 60 cents for a dollar. So that basically means like a 35% yield, but there's a high risk, right? So
so investors want 35% because they feel that that's, there's a significant amount of risk in there that the bond issuer may not be able to make good on their bonds in the future.
Yeah, exactly. So the HYG is the ETF that I usually track that shows the high yield junk bond, and you can see the July was very strong for this bond from the low of the 72 all the way to 77. But another surprising fact that I saw, Brian, that I thought I'll share with you as well was the fact that the net issuance was flat. And so this, if you see my screen, this kind of shows when high yield is, the companies are issuing more capital. And if you do this with Fed cycling, Fed rate hike cycles, it's almost identical. So whenever Fed is easing, so in 2009, companies are issuing more debts. Whenever Fed is hiking, you'll see that. So right around 2018, when Fed was hiking, you saw the net issuance coming down tremendously. It's kind of same story again over here. Net issuance was flat for the last 12 months,
right?
Just because companies were either couldn't really raise capital, or maybe they had the cash, they didn't need it. But I personally think the reason for that is rates going up, cost of capital is increasing, so they're not really issuing any debt at this moment.
Yep, no, 100% agree.
Yeah, and then another one is this one on my screen is based on rate hikes in 2023. So right after that Fed's meeting that you said, the expectation since Powell spoke now for 2024, the expectation of Fed funds is 2.6. So the market is seeing rate cuts coming in early 23, which is really surprising. That's what the market is really pricing in.
And that's sort of an anticipation, or at least the idea that the bond traders are saying that we're going into recession. That's the only way to read that is that the only reason the Fed would start to lower rates would be because the economy's going into recession.
They want to stimulate the growth.
Yeah,
right?
You want to stimulate growth, so you cut your interest rates. But so that's an interesting. It's a real interesting read on what the bond traders are seeing and what they're thinking about where the economy is going. I mean, there's this ongoing debate now whether we're in a recession or we're not in a recession. I mean,
what do you think, Brian, in your opinion?
There's still lots of jobs, and I heard a statistic as I was driving down here. There's like for every available worker, there's 1.8 jobs.
Wow.
Which is amazing. Now they're saying, of course, on the flip side, that's a lower number than the previous number.
Yeah, that's good.
But it's still, that's almost 2 jobs for every worker that's looking. So, maybe the trend is going in the right direction. I don't know, but again, with the Fed looking to cool the economy.
Yeah, I mean, if you don't consider, as I'm loading my trading platform, because I want to take a couple of trades before the close, if you consider the traditional definition of 2 negative quarters, I mean we're in recession, but I think they look at different metrics, like how many jobs opening there are, the job numbers, all that stuff. So that's debatable. But even if we think this is a recession, I don't think the severe recession would come maybe in the next 7-8 months. We have to wait a little bit because there's not enough slacks. Companies are just now taking away job offers, letting people go. So this takes time, right? Like we talked about that hope structure, like where the employment is the last thing you see really in terms of the economy.
Yeah, it is what they call a lagging indicator. So you don't see that. You don't see a recession coming, or it's not a predictor of a recession. It's one of the last things that end up showing up is the employment rate. So
Salty, shout out Salty. Salty is asking, or did you go long Vanguard Growth ETF yet? I added Qs yesterday to my portfolio because it just seems to me, again, we might have another leg down and I might be so wrong, but looking at this data that I saw over the weekend, which basically is showing the rate expectation, and basically the market is expecting rate cuts by March 2023. This kind of shows me that, hey, growth is back. It seems like growth is back. Of course, not a massive size, just 100 shares of Qs, and I'm gonna write a covered call on them. But I thought right now is a good time to add Qs to your portfolio. Again, yeah, I missed the massive rally in July, but you have to kind of wait. If you're kind of a macro trader, you know, looking at this stuff, you have to wait for, in order to get some kind of a confirmation. So I'm not really worried about that. But yeah, to answer your question, I did add the Qs, so I think that should work, hopefully. What else we got? So let me go and see what earnings we got going on. So I'm in our calendar. By the way, we have about 60 people joining us live. Thank you for joining us. Give us a thumbs up. If you haven't subscribed to our channel, definitely subscribe. We go live 3 times a week. Today we're interviewing Dr. Gary Dayton, author of Mindful Trading, a clinical psychologist, more than 20 years of experience in trading. We're extremely honored to have him on. He was supposed to come on last week, but unfortunately he had COVID. Hopefully he's feeling better and it will be fun. I'm really excited. Make sure to subscribe so you can comment in our chat section, and if you have questions you can let us know and then we can ask Dr. Dayton live. We got AMD, PayPal, Airbnb, Starbucks, a lot of stuff. So PayPal I'm definitely trading, doing a straddle. Let's see what the expected move on PayPal is. AMD, I don't know, Starbucks, and then Airbnb. Brian, what are your thoughts? Are you trading anything?
I typically don't like to trade anything into earnings. I mean, I did. You know, I was when in the closing show yesterday. I was saying that I wanted to sell some puts on Uber.
Yeah.
And that's just basically you know, an expectation that Uber wasn't going to overly disappoint. And
apparently Jared talked you out of it.
But Jared talked me out of it. No, we always like to give Jared a hard time, but no, I made a decision, and I decided, you know, there just wasn't enough premium in the option to make it worthwhile. I mean, if it really done a belly flop, you know, for the 50 or 60 cents I would have collected for $50 or $60, I would have collected for an option. You know, it could have really blown up. So, but unfortunately, you know, of course, it turned out that it would have been a good, would have kept the money, but whatever. So this one I'm not really trading. I've got some. I do have some Amazon options that I sold calls. That'll expire at the end of the week. They're 140s. So
okay.
I typically like to wait till the you know, till the earnings come out, and then find a top. And especially in this market, you know, whether it's a top or a bottom, more likely a top, and then sell options above it.
Yeah.
Sell call options. Just hope they expire worthless, which it looks like Amazon's heading that direction. So
I'm in that trade with you, by the way. I've sold not naked. I did a spread, so just to hedge, but I'm also selling some a spread on Amazon. So expected move on PayPal, Brian, is about $8. So less than 10%. PayPal is a company that is down more than 50% year to date. So I'm gonna take this a straddle. I think there's a lot of pent up demand. I'm gonna take this trade, about 5 contracts. Hopefully I'll get filled. Let's see what the expected move for Airbnb is, and whether or not we're gonna make some money over there as well, because both of these companies have earnings.
So what strikes are you looking at for PayPal?
So PayPal, I'm going right at the money. I'm buying a call and buying a put. Okay. So basically, I'm betting that the move is going to be more than $9.
More than the $9.
Yeah. Which $9 is about 10%. If you compare it with the previous, and there we go, we just got filled. If you compare it with previous earnings, 10% move is not a lot. The only thing that is a little concerning for me for PayPal is the implied volatility is really high. It's about 75%, and we're probably going to lose a little bit of value because of volatility crush after the earnings, but that's okay. and I'm just gonna really quickly check on Airbnb, and we're gonna have our guest, Dr. Gary Dayton, join our show really soon. Maybe if our producer could send him an email and tell him we're ready for him, it will be amazing. Let's see what the expected move is on Airbnb. Expected move about $10 on Airbnb too. Brian, I think I'm gonna take this trade too. I think it's a reasonable expectation.
Yeah,
What do you think?
Airbnb has already run quite a bit today. It's up. The last time I looked at it, it was up about $6.
Yeah.
So it's already sort of moved in anticipation. So it's going to be. What's Airbnb up to right now? Yeah, it's up. Yeah, it's up. Yeah, it's pretty much up. It's almost $6, over $6.
Yeah.
So nice move.
It's going to be interesting. So for those of you who are in the chat watching, just really quickly, I wanted to show how it's not loading. So let me bring this up because I want to spend time because this might be new for people.
Oh, good. You got charts. Excellent.
All right. I believe we have Dr. Gary Dayton on the line. Dr. Dayton, how are you? Welcome to the show.
I'm good, thanks. How are you?
Good. Yeah, absolutely. I think we have you on. I think your camera is slightly to the right, so we don't see you completely. There we go. This is perfect now.
Oh, well, hang on a second. Let me play with it. How's that? A little bit better?
Yeah, that's amazing. Yes, that's pretty good, actually. Thank you so much for joining. How are you feeling? I'm so sorry about last week. I know you got COVID. Are you feeling better?
Well, it's my apology for last week. Yes, we had gotten COVID that day, tested positive. And in the sturm and drum of all of that, we ran off to the doctors to get treated, and basically slipped our mind. Actually, Helen, I had thought it was the next day, and Helen forgot to tell me about the day. So anyway, we're at fault here. We apologize, but our health is now back back up to snuff. I actually did get a rebound. We had gotten COVID. 4 or 5 days later, it was gone, and then 4 or 5 days after that, it came back again. So I had that rebound effect that the president of the U.S. is having.
I was going to say you must have had the same bug that the president got. So there you go.
Exactly.
You're in good company.
Yeah, that's right. That's right.
Yeah. Well, we're absolutely honored to have you. Thank you so much. We have over 100 people joining our show right now. As you know, it's a YouTube show and it is live. So thank you for agreeing to come on the show. Dr. Dayton, before we start, of course, you've done webinars for our community before, but could you give us a quick background about your experience in the market and as a clinical psychologist, and we'll start from there.
Sure. Well, I became a clinical psychologist. I have a doctorate in clinical psychology. I went to Rutgers University. They have an excellent clinical program. And I concentrated in cognitive behavioral clinical psychology, along with some organizational psychology as well. And I worked in the classic clinical settings of medical centers and the VA hospital, the Veterans Affairs Hospital, where combat veterans, Army, Navy, Marine veterans go for when they're ill. Over time, I developed more of a practice, much less so. In fact, I don't do any more clinical work. All of my work today is with other traders primarily, although I do some work with musicians and with writers and other performers. Athletes I've done in the past as well, but mainly it's traders these days. And then in terms of trading, I started trading back around 99, 98, maybe late 98, early 99, somewhere around that time period. Traded all kinds of stuff, from stocks, started with stocks, traded a lot of commodities, and kind of settled in on day trading and trading the S&Ps on rare occasions these days now, because the S&Ps offer so much opportunity, I'll trade a little bit in the crude oil market as well. But all futures, all futures.
Yeah, that's amazing. We also have a lot of our traders trade the future market. I primarily myself, I'm mostly an option trader, and just before you coming on, I did a couple of straddles on PayPal and Airbnb going into earnings because I felt like the premium were a little cheap compared to historical. But we're definitely excited to have you. Kind of starting with the market. Is this, since you've traded in the 90s? How is this bear market different? What are you seeing? Is it more difficult? It's my first real bear market trading, and it's been challenging. So really want to get it from your
Sorry,
perspective.
that's the
Yeah.
U.S. markets closing.
Yeah, that was a closing
Apologize
bell.
for that.
Yeah, no
We all
problem.
got that.
Yeah. Okay. Um, it's not a lot different, I don't think. The volatility is a little greater, I would say, in this bear market than we saw back in some of the days in the well, not the 90s, but in the 2000s. Certainly after we were in 2001, that was a pretty good sized bear market going into 9/11, and in the aftermath of that into 2003. And then the 2007, we watched that unfold right from the top. We saw massive volume up there, 2006, 2007. Go take a look at a SPY chart, SPY, and
Yeah.
look at the heavy volume there that was developed at that point. All of that selling that was going on, and so we could see that. And that was probably similar to the volatility that we have now. In terms of day trading, frankly, it doesn't really affect me. I wouldn't be trading if I were a swing trader. I wouldn't be trading long for sure. I probably wouldn't be trading at this point. It's very difficult to do it in a bear market.
Yeah.
We've been looking at a rally in the S&Ps, and I've been looking at that for a few weeks now as it's been developing. But boy, it's really hard. I think it would be really hard to trade that to the long
Yeah.
side. And there's cause to get up to around 4,200 easily enough. We're almost there now. And there's even more cause. In other words, a lot of preparation in the market to bring it up, possibly even into new highs. But boy, I'll tell you, it's very uncomfortable to try to trade when you're, especially trade long when your overall market is down. And if you're going to do it, I think options would be the way to go. And I'm not real sophisticated in options, but I'd be trying to manage that risk as much as I could, and, using spreads and that sort of thing.
Yeah, definitely.
Yeah, I think your comment
Brian.
about swing trading certainly has been echoed by myself and other guests we've had on. It is definitely a more challenging environment to be swing trading in right now. It's hard to know what.
But day trading is fine.
Yeah.
Yeah, day trading is fine. We're just looking to try to kind of get in close to the day low and get out close to the day high.
Yeah.
And trade in between, and it really doesn't affect us. It doesn't really matter if the market's going up or down.
And as a commodity, I mean, you trade commodities too. It's a little bit more difficult to manage risk with commodities because they tend to be more gappy. Like they'll, like you look at oil or any other commodity, you see, more significant gaps between opening and closing prices. Compared to stocks, barring any news, of course. So I would say commodities are definitely a little more challenging to trade just because of that.
Sure, but the largest losses I've ever experienced, and I'd be embarrassed to tell you how the size of them, because they wiped out my account. This was early on in my trading career, but limit downs. The market would open, and you'd get no chance to even get out of a bad position because it went limit against you.
Yeah.
And you got to wait till the next day, and the next day limit down again. And that's a real difficult experience to have to go through.
Yeah, Dr. Dayton, I'm just curious, since we talked about commodities, did you trade the oil going negative? How was that time? That must have been really, really interesting times when in 2020 oil when crude went negative for a brief moment.
Yeah, I don't think I was really in the market at that point in crude, probably still trading just the S&Ps. As I say, it's pretty rare that I even go into the crude oil market anymore.
Yeah.
But again, well, I'm assuming we're going to get to the talking about Wyckoff, but that decline, it was had a nice little pattern, monthly kind of pattern to it from around up in the high levels of price all the way back down to the bottom. So
Yeah, definitely. Speaking of that, actually, let's get there. So in my chart, I have the SPY chart up, and as you were mentioning it, the volume in 2008, 2009, a lot of volume. But you mentioned you mostly do day trading, and kind of want to kind of get your brain on that. And I know you're very experienced. You trade using a different indicator that not a lot of people have heard of, the Wyckoff. Can you give us a little bit kind of insight on that and how you're using that as your edge in day trading?
you mean the Wyckoff method itself?
Yeah, the Wyckoff method. Yeah, absolutely.
Sure. Well, I started out like everybody else with all kinds of indicators on my chart, Japanese candlesticks, all of that stuff. And trading the S&Ps, there's a lot of internal. There's the advanced decline, number of new highs, new lows, TRIN, VIX, all of that stuff
Yeah.
that you can get into, and presumably helps you to read the market better. And I'm sure it does for many traders. Um, but the fellow I really learned trading from, who died last year, David Weiss, was an expert in this method. And when I went up to see him, he lived in Boston. I went up to see him one day, and we got a chance to sit down in his trading room. And he had a very clean screen, price bars, open high, and close, and volume. And that was it. And that was it. I was impressed with that, really impressed with that. And that is the Wyckoff method. It's just looking at the chart from a price and volume perspective only. You don't need anything else if you're skilled in the method. Um, so I dropped all of that stuff. Now, Wyckoff himself, Richard Wyckoff, was many technical traders consider him to be the father of technical analysis. Charles Dow, Richard Wyckoff, Ralph Elliott, and Schabacher. I forget Schabacher's first name. Those are and Gann, I guess you'd put Gann in that, William Gann in that group as well. Those are the folks who really kind of sussed out how trading worked and how to technically read the charts and what have you. And Wyckoff came to Wall Street in the late 1800s, in the late 1880s. I forget the exact date. And he died around 1934, I think, maybe 33, somewhere in there. And in that period of time, he arrived they were still trading under the buttonwood tree when he came to Wall Street. And he was a runner for a brokerage firm. Then by the time he turned 25, he owned his own brokerage firm, one of the biggest on the street. And he created a newsletter, actually a few newsletters. And in fact, his newsletters would often move the market. If he recommended buying or selling a stock, it would often shoot up or drop based on his recommendation, because so many people were reading his newsletter. But his approach was strictly looking at price and volume. He used point and figure charts, and then just a standard, what he called a vertical line chart, which is a high, low, close, and volume. And that was it. And reading the market from that perspective. And I teach it every Thursday night, in fact. We do an hour and a half. Traders across the globe come in, and I'll set them up. We mostly do day trading because that's where my expertise lies. But we are, looking at the chart, identifying from the higher time frames, and this is kind of what we do through the Wyckoff method. We'll look at the daily chart, we'll look at the 240-minute chart, kind of identify, is supply coming in, or is demand strong, or what's going on here. And there's certain principles that we want to understand and know about in the Wyckoff method. But that sets us up for the following day's trading. And we've already identified key levels of support and resistance. We've got a bias going in, whether we're long or short. We don't hold on to that tightly. We hold on to it lightly, in fact, because we can certainly be wrong in our analysis, and we'll find out really quickly if we are trading intraday. But you can use this method on an intraday basis, looking at the current market's action from price and volume, and that will help you determine what the next likely move of the market is. And you can do it on a day trading basis on a 5-minute chart, or you can do it on a daily, weekly, monthly, quarterly, yearly chart. You can do it on swing and position trades as well. In fact, Wyckoff was more of a position trader, where he was going for 10, 20, 40 points on a stock. Although he also happened to write the first day trading book ever to be written, at least in the United States, that I'm aware of. So that's the method we follow, and you might think, okay, the guy was around around the turn of the century, 100 years ago, last century. What could that possibly do? How could that possibly be meaningful to us today in the 21st century with all our technology and stuff? And I just love it when people say that, because I think to myself, great, you guys keep doing that, and I'll do what I'm doing, and I'm happy doing that. But to not be so cute about it, there's so much valuable information in the Wyckoff method that is so applicable to any actively traded market today in 2022. It's an amazing method.
Yeah, absolutely. That it's very interesting that you mentioned that, and the format of the show is we get a lot of guests on the show, and with different backgrounds, like institutional traders, psychologists. And one of the things that we hear quite often is that when the market regime changes, then your edge has to change as well, because different regimes requires different techniques. And it's very interesting you saying that you're basically, what you're saying is, once you figure out the price and the volume, that's all the edge you need. And if you wanted to kind of define your edge in the market, would you say it's knowing how to use the Wyckoff method? Is that a good interpretation, or?
Oh yeah, for sure. I mean, the market is a mass group, and it's a massive group that's moving the market, and they're doing it with individual trades, but collectively they're all acting together. In fact, Wyckoff used to call this the composite man. Of course, we don't use gender necessarily today, so we would refer to it as the composite operator. And it's the smart money, the well-informed interests, those folks who have lots and lots of capital, very intelligent, hire very intelligent people. They know everything about the companies that they're trading, and they specialize in they're not going out and scanning for lots of stocks. They specialize in stocks, and they know those companies inside and out, and they trade them, and they actively trade them. And that's who's moving the market from a Wyckoff perspective. And what we want to do is not try to think ahead of them at all. We want to follow in their coattails. And the way we follow in their coattails is through the footprints that they leave in the market. And the footprints that they leave are readable in the price and volume. And that's, in a nutshell, how that works.
following the smart money. Um, we're getting tons of questions, by the way. Again, over 100 people are watching this, and just for our viewers, so they understand. You mentioned you have this mentorship going on Thursday. How's the best way to kind of reach out to you? Is it the Trading Psychology Edge website? Is that the best way? And is there any book recommendation you have on the Wyckoff method? I'm just reading the questions and the comments and kind of reflecting those right now.
Sure. Yeah, so my website is tradingpsychologyedge.com. And you can go to my website, excuse me, and look for a program called Deep Practice. You can also just Google, Dayton and Deep Practice, and I'm sure you'll find it. And it's called Deep Practice for a reason. Psychologically, how do you go from good to great or good to competent to great? And in psychology, it's called deliberate practice. You might have heard of it. There's been a few popular books written about it. And the deep practice that we do every Thursday night is about the Wyckoff method and basically tape reading the market bar by bar as it unfolds, minute by minute. And it's structured in a way so that selecting things to teach that are going to put you a little bit on the edge of your envelope, so to speak, right to the edge. And you're likely to make mistakes, and that's great, that's fine. Mistakes are welcomed because those are opportunities to learn from, and we discuss them when that occurs, and discuss why, if we're going to take a trade in this market that we're studying, we talk about why it's a bad trade. Or why it's not such a good trade to take, and sometimes we talk about the psychology behind it as well. So we get a chance to talk about the whole gamut of trading as we're doing that. And as I say, it runs for about an hour and a half. People from all over the globe, and of course it's recorded, so you get a chance to review it if you want to, or if you couldn't get there at the time, it's available for you afterwards. So that's from my site. There are a couple of good books on Wyckoff. I would encourage anybody to start with something called Charting the. I think it's called this, Charting the Market, the Wyckoff Method, and it's written by Jack Hudson, Hudson. He edited the book. And that's a good introduction on the Wyckoff method. The other good book I would suggest is my mentor David Weiss's book called Trades About to Happen. Those are two good introductory books into the Wyckoff method.
Very amazing. Brian?
Yeah, no, that's good. I don't really have anything else to add.
Yeah, absolutely.
Yeah.
So I have Trading Psychology Edge up on my screen. Maybe our producer can show, and then the Deep Practice with Dr. Gary. It's over there as well. So tons of information over there. Since we've covered the technical aspects, let's get into psychology. I'm kind of curious, Dr. Dayton. You've been trading more than 20 years now. Do you still experience the FOMO, fear of missing out, and all these psychological aspects of trading? And
sure.
how are you kind of combating those?
Yeah, sure. I feel the fear, the anxiety all the time, and so does every other trader that I know. In fact, I'm blanking on his name who wrote the book. There was a book called Traders at Work, and he interviewed over 200, Borkin, what's his name? What's his first name? He's a friend of mine too. I'm embarrassed, I can't remember his name. Anyway, he interviewed over 230 really good traders, very successful traders. And one of the surprising things he found was that traders still get uncomfortable in their trading chairs when they put on a trade, even after 20, 30, 40 years of trading. And that was the case with David Weiss and Tom Williams as well, who I also worked with, another Wyckoff exponent and very proficient in the method, English fellow. Um, um, we all do. Of course, we all do. You can't not experience emotions. Traders come to me and say they want to get rid of their emotions. I laugh at them because you can't do it, and you
Yeah.
don't want to anyway, because the emotions bring in information. But you need to learn to work with them. You need to learn how to relate to them. And one of the best ways to do this is through the practice of mindfulness. It's an ancient Eastern tradition coming out of the northern reaches of India and Nepal, some at least 2,600 years ago, probably more like 3,000 years ago. And those methods are still very useful today. Mindfulness and meditation, mindfulness is just meditation is the formal practice of mindfulness. But mindfulness teaches you that your thoughts are just thoughts. They come and go on their own. They're triggered by something in the environment. We start to get, for example, I'll give you an example I often talk about. We're in a trade. Let's say we're long, and we've got, I don't know, we're in an S&P trade, and the target is 10 points up from us, and maybe we've got 3 or 4 points in the trade. All right, and then the market starts to tick back against us. It starts to pull back, and you can feel the anxiety start to build, right? Oh, Gary, you better get out of this trade. You don't want to have a loss here. And you can book 3 or 4 points is a lot better than zero, and it's a lot better than minus 3 or 4 points if you take a loss, right?
Yeah.
And so you kind of struggle with that a little bit. Oh, I'm trying to get rid of it. I don't want it. And then it ticks back a little bit more. Maybe it really jumps down a bit, right? And of course, you're living and dying on every little tick, which is the wrong approach to begin with. But you're living and dying on every little tick, and so and then your mind starts screaming at you, Gary, get the heck out of that trade. And you do. You get out of it.
Yeah.
And what happens? Oh, relief comes in. All that stress is gone. Doesn't that feel good? What a good boy am I. I've booked 3 points on my trade, and I can relax now, you know? And then what happens? 5 minutes later, the market, boom, shoots straight up to your 10 point, actually goes through your target. And what happens then? What does your mind say to you at that point? If it's anything like my mind, it's saying, Gary, you idiot. Will you never learn? What's wrong with you? Why did you take that trade off? Right?
Yeah.
Is this a common experience or not for folks? Very
Oh,
common,
very
Yep.
common.
as I see it, right?
Yeah.
But here's the thing. Traders never ask, well, which mind was right? Was it the mind telling me to take the trade off and book those profits because I'm going to have a loss? Or is it the mind now chastising me for doing exactly what it told me to do a few moments ago? We never ask that question. We continue to believe both. And that's a very bad relationship to have with your mind. Your mind is not always your friend in, in, in this regard. It's very valuable, it's very useful, but it can get you into trouble very easily. And you get stuck in this pattern, and the next time around a trade sets up and you're in it, and you're in it for 3 or 4 points, and it starts ticking against you, and you feel the anxiety, and oh, I better get out and save the point. You're going to do it again and again and again and again. And the reason is because you're getting relief from the stress. You're feeling that relief come in, and that's a very potent conditioner that will have you do that over and over and over again. So mindfulness starts to break this up, starts to give you some distance on your thoughts and your feelings, so that you can be more consistent with your trading, and you can honor your plan more. right? You spend a lot of time researching, developing, optimizing and getting good trade setups and all the criteria in your trading plan. And then you get into the market and you throw all of that out. And you're listening to the mind. And it's an anxious mind, and it's dense with anxiety, and it's all jumbled up in there. That's not the time to be listening to the mind. You want to honor that trading plan that you put so much effort and work into.
Wow, love it.
Yeah, I really like the point you made about, how you're stressed when you get in a trade, and just getting out of it and just sort of relieves that stress.
Yeah.
It's something that we all experience as traders. I don't think that if you don't have any emotions if you're not feeling that stress and feeling that relief once you're out of it.
Yeah, 100%.
So yeah, 100%.
Right. So when we're operating from a more mindful perspective, we still feel the stress, but we notice it and we say, "Oh yeah, that's the stress that normally comes up. I know why it's coming in. There are reasons for it. They're very good reasons. You're under threat. You're under a threat,
Yeah.
and your body and your mind is going to respond in that way. If you understand that and you understand how to work with it through a more mindful approach, then it becomes, just like any other feeling that comes in and out. It kind of hangs around for a little bit, might build up into some with a little bit of intensity, but eventually it goes away on its own.
Yeah.
So you don't have to be dictated by what your mind and feelings are telling you.
Yeah. So, well, very well said. You mentioned something that was really interesting to me was we never ask which mind is right. Like the mind that was telling us, hey, you should have hold, or the mind that kind of encouraged you to sell off. And that kind of brings me to this question. Some people are inherently risk averse, and some people are maybe, and again, correct me if I'm wrong, some people are more risk taking. Do you think your mental bias kind of helps you in trading? Do you, like in your practice, do you find people who are more risk averse, as an example, tend to be better traders? Or no, everything can be trained and you just need to sit down and just train the mind?
Yeah, I probably fall in the latter camp. It's being risk averse at times is not such a bad thing, but being able to step up and take the risk is not such a bad thing. You have to do that. You got to
Yeah.
pay to play, so to speak. You got to make your bet, and there's always risk involved in that. So you have to have some tolerance for risk. There's no question about it. If you're totally risk averse, it's probably not the business for you. You know,
Yeah.
you probably would find a more congruent and an easier go at it in some other business than trading. But
Yeah.
we all feel, as I say, we all feel the tug of anxiety when there's risk there. There's no question, and I think that's a good thing because it keeps us sharp.
Yeah, definitely. Speaking of mindfulness, you of course authored the book Trade Mindfully, and you kind of broke it down into three main segments. You know, understanding your mind, psychology, and then maximizing your trade performance. Kind of on the topic of understanding your mind, what are some of the key things that you think traders should do? To really understand their own psychologies, their own biases going into before actually start day trading, because it's a tough business, and we all know it's a tough business.
Oh yeah, it's a very tough business. Yeah, you should spend a lot of time practicing in simulation before you get to the point where you're actually putting real dollars into the live market. But the first part of the book, Understanding Your Mind, is all about our thinking. And in fact, the webinar that I did for you is basically a summation of the key mental biases that we come to trading with, that we bring into trading. We have we're evolutionary creatures, and our minds are still evolving. They're not perfected at this point by any far stretch of the imagination. And so we have what cognitive psychologists and cognitive scientists would say are are flaws or systematic biases in the mind. A good example, a simple example, is the recency effect, where you have 3 or 4 losses in a row, and the same trade sets up just the exact same trade as the last loss, and you feel the hesitancy to not take that trade. And a lot of people won't take the trade. They'll let it go, despite the fact that it's a perfectly good trade setup, meets all the trade criteria, and despite the fact, even intellectually, they might understand, well, statistically, every trade is independent of one another, but boy, I just had 3 losses in a row. I'm not going to take another one, so I'm going to let this one go, kind of thing. And again, that's the mind at work. Mindfulness helps in this regard as well. But the key idea that I wanted to introduce in the beginning of the book, most traders come in and say, oh, I've got these emotions, fear or greed, hope, and I got to deal with those. I got to get rid of those emotions. Tell me how to do that. And what I'm trying to get traders to understand is you need to start first with how you think before we get to the feelings, because a lot of times the thinking flaws that we have in our mind or in our brain create situations that then emotions start to blossom and bloom up, and then we get hijacked by those emotions. But it all starts with faulty thinking, and if we can at least understand those and start to be able to address some of those, then it also has an impact downstream as well. So that's the beginning of the book. That's that first part about understanding your mind.
Wow, love it. Dr. Dayton, if somebody want to get into mindfulness and want to start this practice, what's the best first step in your opinion to adding this routine into their trading regimen?
Sure. Start small. Start with just 4 or 5 minutes a day of watching your breath. Here's what mindfulness is in a nutshell. And there are various forms of mindfulness. And this isn't the only one, but this will build concentration, and concentration, of course, is useful in the markets in general. But that level of concentration allows us to remain focused on the trading task at hand, no matter what it is, whether it's setting the stop or managing the trade once we're in it. Rather than get hijacked by our thoughts and feelings. We're going to have a lot of distracting thoughts. Always, I'm going to have a loss if the market starts ticking against me. But mindfulness helps us see that that's a distraction, and that we want to maintain our focus on the trading task at hand. Okay, so in meditation, the task at hand is to watch the sensations of the breath. And that's a basic classic way of doing meditation. And as you do that, will quickly notice that your mind will take you off of it. It'll distract you with some storyline that it creates. Suddenly you've been watching the breath for a few minutes, and then suddenly you find yourself on the streets of Paris at a cafe, sipping a cup of cafe au lait and watching the people go by and commenting on how they're walking and stuff. And suddenly you wake up and you say, oh, I'm supposed to be watching the breath. Well, that's good, because that's what mindfulness is all about. This is the moment where you want to notice that you've drifted off in a distraction. You relax a little bit, and then you bring your attention back to the sensations of the breath. And that's all meditation is. It's just returning the mind, once it gets distracted, back to the focus or the object of attention or the task at hand, whatever it is, however you want to define it. It's just bringing yourself back to that over and over and over again. And wow. Yeah, and that is the basic practice. So start that small, 5 minutes a day. Find a time where you're not going to get distracted. turn this thing off,
Oh yeah.
turn this thing off,
Oh,
right?
that's the worst.
Yeah.
Yeah.
Yeah. And tell everybody else you don't want to be distracted or disturbed, that this is your time, so to speak. And you sit there for 5 minutes and do it, and gradually build it up over time. A good, I do between 30 and 45 minutes a day. You don't have to do that much, but 20 minutes a day is a really good amount, a really good amount. Doesn't matter if you do it in the morning, in the evening, or the middle of the day. I've got traders who like to do it at all of those times, and all of those times are effective.
Yeah, it's so interesting. I find myself, especially with social media and the TikTok and the Instagram, I'm constantly, I can't really sit still. And I think mindfulness is exactly the practice of sitting still and, really that first thing that you said, having that conversation with your mind and knowing, okay, which mind is right, and really accepting that. Yeah, that's definitely true. Brian, anything from you?
Yeah, no, I do a bit of that myself with, because I do practice yoga fairly regularly, a couple times a week at
Yoga's
least.
great.
Yeah, and so there's a very big element of mindfulness involved in that. So it's certainly, I certainly know what Gary's talking about here.
Yeah, so we have a few hundred people watching the show live, and they're probably gonna a few thousand will watch the replay. So we're extremely happy and honored to have you. Thank you so much, Dr. Dayton. One of the questions I wanted to ask is, since it's a bit of a best of two worlds, you're kind of psychologist as well as a trader. Has there been, working with your clientele, has there been like one specific personality trait that you found that these guys are the killers in the market, they're doing very well, or not really?
No, not really. It's interesting. The best traders I know are pretty calm, fairly coolly collected kinds of folks. They put on a trade. I remember the very first time I met my mentor, David. We were at a live trading event. I think we were down in Florida, and I sat down next to him, and he actually he put on a trade and took it off maybe 10 minutes later. This was in the S&Ps, and he got a few points. And I'm just about jumping, this was early on in my career, and I'm just about jumping out of my chair. Oh, wow, you got, 4 points, 3 points. That was a great trade, blah, blah, blah. I'm like really excited about it. And he kind of looks at me with this kind of, half smile on his face, but he kind of levels his gaze at me. And it was at that moment I realized this guy doesn't get excited about winning. And and as time went on, I learned he doesn't get really excited about losing either. So, it's personality is mostly somebody who can sit there and be fairly calm about it. But, I'm not, I don't know. There's a lot of debate about personality. But let's take it outside of trading for a moment. Think about athletes, right? A Derek Jeter versus a Roger Federer versus I'm a big tennis nut, so like Rafa Nadal or a Novak Djokovic, or a Serena Williams versus a Chris Everett versus everybody's got a different personality. All these athletes who are performing at the top of their game, they all have different personality characteristics. They all have different quirks and aspects and features of their personality that are, everybody's a little bit different, and yet they all are able to do that. And I think that's the case in trading too. I think if you are toned really anxiously, and maybe have, could be diagnosed with an anxiety kind of disorder, that might be an issue for you to first sort out before you get into trading. The other thing that I've found over time when I've done, I've done personality inventories or assessments of traders and other performers, and people who kind of tolerate a lot of disorder, who kind of tolerate chaos and messiness and that sort of stuff probably aren't as good at this as somebody who's a little bit more orderly, a little bit less anxious, and those kinds of characteristics. But beyond that, in general, there's a wide range of personality types that I've seen in this business, and I don't think any one personality is a trader's personality. I don't think you'll ever find a gene for the trader's personality, um, no matter how hard they strive to find one.
Yeah,
Right.
love it. That's very well said. I think there was a research done that looked at the cars that the hedge fund managers were driving versus their performance, and they found out that hedge fund managers that were driving like Toyota, more of a exactly what you're saying, like more of a calm cars, beats like statistically significantly beats hedge fund managers that were driving sport cars. And that kind of goes to show exactly what you said of being calm, and it's not about really screaming, oh, I got like 10 points out of SPX, rather being really calm and collected and separate that emotions from it.
Yeah.
Yeah, and trading is one role that you have in your life. It could be a big role, but you're also most likely a father, a brother, a mother, a sister, a daughter, a son, a sibling, a community member, an employee or an employer. You got a whole host of roles that you do in your life, and you need to pay some attention to those as well. It's not just trading. And I think when you treat trading, as a specific discrete role that you do, among many other roles, you do kind of have that more calm perspective, a more even keeled kind of perspective, and I think that helps. I think that helps in your trading as well.
Definitely.
Hmm.
Brian, anything from you?
No, I think that pretty much sums up what I think we all believe is,
Yeah.
certainly the more emotional you are. We talked about this at the beginning of the show here. The more emotional you are, the more you let your emotions rule your trading. Probably the more difficult time you're going to have. So if you can stay cool, stay in the moment, control your emotions, then you're probably going to be much better off. And then, of course, this circles back to the mindfulness we were talking about, how to use that mindfulness technique to control your those initial emotions that you might have, anxiousness when you're in a trade. So yeah, it all really ties together.
Yeah, absolutely. So tradingpsychologyedge.com, I'll put it in the chat for our members as well. I have it up in my screen. And then there's a deep practice with Dr. Gary. That's the one that every Thursday, about a 90-minute sit down with your community members. Dr. Dayton, we are extremely honored to speak with you, and we're so glad that we get to do it. Unfortunately, we couldn't do it last week. Again, over 100 people, and I'm reading the chat as members are typing, and the feedback has been tremendously positive, and everyone's loving it. What's the best way for our members to keep in touch with you if they wanna know more? Trading Psychology Edge, is that the place to be?
Yeah, that would be. We're about to launch a new website in September, I think, another month or so, and we'll have more of a membership type of arrangement with more offerings to the members. And so one of the things, if you become a member of Deep Practice now, you'll automatically at the same price um, become a full-fledged member when we bring the new website live. And we're going to do monthly psychology webinars for that membership, as well as monthly Wyckoff webinars as well, in addition to the deep practice and other things that we have in there. So you can look forward to that. So that's one way to stay in touch with me. The other way to stay in touch with me is on Twitter. My handle is DRGARY Dayton Dr. Gary Dayton on Twitter. You can look me up. And I pretty much post every day a little uh, tweet along with a chart on what I anticipate the S&Ps are going to do and where key levels of support and resistance lie for the coming day. So you can follow me. And I also do some psychology stuff too. So you can follow me there.
Yeah, amazing. So in the screen behind me, if our producer can get it, I have Dr. Dayton's Twitter account, so we'll put it in the chat as well for our members to follow. And thank you, Carlos, for setting up this interview. I personally got a ton of value out of it, Dr. Dayton. One of the things I loved is how simple you kept everything. And you know, we know human mind can be very complicated, and same with trading can be very complicated. But I don't know who said it, but when I went to business school, and on our wall in business school we had a quote. I don't remember who said it, but it says, "Investing can be very complicated. The genius is in keeping it simple." And that was the first thing I learned in business school, and I kept it with me. Try to keep it as simple as possible. So we're extremely thankful. Thank you so much. It was awesome.
Yeah, thank you for your time. Appreciate it.
Well, great. It was good great questions you had. Great talking with both of you, and appreciate all the listeners too out there listening to me drone on. Always love to talk with other traders and connect with them. So thank you very much for this. This was a lot of fun to do.
Thank you. You're a fantastic speaker, Dr. Dayton.
Can you take us out with a riff on the guitar in the back there?
Yeah, that's my bass guitar. Yeah.
Oh, okay. Yeah. All right.
Actually,
when I want to relax, that's what I go to. Is my bass.
Well, that was how Einstein came up with some of his great, his great revelations. If he got stuck on something, he'd go and play the violin.
Oh, is that right?
Yeah.
Oh, wow.
Yeah.
There we go. Yeah, that was actually one of the questions in the chat. If playing the bass give you a trading edge, which I thought was really funny, but I didn't ask you. But that's amazing. Dr. Dayton, thank you so much for your time again.
Yeah, thank you.
Have a good one.
All right. Thank you all. Take care now. Bye-bye.
Okay. Bye now.
All right, so with that brings our closing bell, or the last 30 as you call it, Brian, to an end. Very great conversation. I personally really enjoyed it. I enjoyed how simple Dr. Dayton kept it, and the fact that just stay calm, remain calm. I just did 2 trades today live, PayPal and Airbnb. I don't think any of them made the move I was expecting. So. That's part of the game, right?
Yeah. Well, it was funny while we were introducing him, I traded AMD.
Oh, really? Yeah. On your phone?
Yeah.
Oh, man.
Yeah. So I caught when it reversed, came back up.
Yeah.
So it was a profitable closing bell session.
That for you, yes. I don't know for me. I'll see tomorrow. But we got news coming in. I'm at trading terminal right now at the news page, and Robinhood is cutting 22% of their staff. Yeah. Airbnb is doing a $2 billion buyback. Is Airbnb cash flow positive to do stock buyback? That's shocking.
Yeah, Airbnb doing the buyback. Yeah, AMD came in with some pretty good earnings. I think just above estimates, but then I think their full year guidance was a little bit lower on the light side, so that's why initially it sold off.
Yeah. So now it's currently sitting at 105. So it'll be interesting to see how it opens up tomorrow. And PayPal is up. So PayPal is at 101. Actually, looking at the charts right now, both the straddles might make me a little bit of money. So it's not as bad as I initially thought. Anyway, that's part of the game, right? My key takeaways was remain calm. Is just trading, and I'm definitely gonna include mindfulness in my trading platform. I'm actually meeting my doctor tomorrow. I'm getting some anxiety medication, but that's too much information. I'm leaving it for now. Okay. But anyway, thanks everyone. Thanks for tuning in with us, and we'll see you. I'm not sure if we're gonna have a show tomorrow, but we'll see you again this week. Thanks again, and talk soon.
And thank you everybody as well for joining in. Appreciate it. And we'll see you all in the trading room tomorrow if you're going to join us there. Bye for now.
Thanks.